Well, while headline inflation came in at around half of last year's peak, core CPI, which the Fed tends to focus on, held steady at 5.3%. And the report comes as the Federal Reserve begins its two-day meeting, where it's expected to pause rate hikes. Joining us now is Aadil Zaman, Wall Street Alliance Group partner. So, Aadil, in your notes, you are leaning towards a pause like many others. Do you think today's inflation data solidifies that now?
Yes, absolutely. And, the great thing is that obviously the Fed's medicine is working right now. They've been very aggressive with raising interest rates from 0 to 5, between 5 and 5.25% within the past 15 months. And what is encouraging is not only is the number is coming down, but also it's not damaging the economy too much. In fact, we are seeing that unemployment is still at a historic low. And consumers, even though they are cutting back on things like home improvements, they're still splurging on areas like traveling and entertainment. So this to us, Rachelle, points to a soft landing, which is the ideal scenario. And that is why you're seeing a favorable reaction from the equity markets.
And so are we talking a pause and a skip? Because in your notes, you said the Fed's job is done. If you could just clarify exactly what that means to you.
So we think that the Federal Reserve does not need to raise interest rates. We are in the camp that this is it. They should pause now, and they will most likely pause. Inflation has come down from 9% and at its peak last year to about 4% right now, and we feel that it will further go down from here on its own. The reason being that consumers are going to run through the pandemic excess savings. And they're going to cut back on spending, in our opinion, on the service area, which will probably bring down inflation more. Also, this is as you know, this is a very politically charged environment that we are in. And as we are getting closer to the election season, the Federal Reserve is going to be very aware of not damaging the unemployment rate too much by raising interest rates overly aggressive. And we actually feel that the unemployment rate right now is not reflecting the true picture. It's actually understated because a majority of the layoffs have actually been in the tech space. And a lot of those workers are high earner workers that are not really even claiming unemployment benefits. So that's why we think that the Fed is done. Inflation will start to come down more on its own.
And so then in terms of what comes next for the market, the next catalyst, you say fear of missing out, FOMO, and passing of the baton. What do you mean by that? And what is it that they're going to be afraid of missing out on? Are we talking AI or some other part of the market?
So, Rachelle, the reality is that a lot of people have missed out on the market going up, right? Bears in this market outnumber the bulls. And the reason why investors have missed out is because they are thinking that we are going to get a recession, the market's going to go down. In reality, the market does not work that way. The market is forward-looking. So we feel that the recession was in fact priced into the market in last year's decline. And now the market is, already started to go up. And a lot of these people that are sitting on dry powder are going to come into the market, and they're going to go for the less loved sectors in the market, which have actually been underperforming so far.
I mean, and obviously tech gets all the headlines, but when you talked about some of those underperformers, health, energy, what do you see as some of the better picks that are really sort of flying under the radar at the moment as tech sort of overshadows everything else?
Yeah, so we think, the baton is going to be passed from the tech to some of the less loved sectors in the market, especially some of the cyclical areas of the market with the Fed out of the way, we think could potentially do very well. So one of the sectors that we are looking at is the banking sector, right? So the banks have been hammered over here because of the banking turmoil, but we feel that the turmoil is restricted to the smaller banks. The bigger banks actually, we think, are beneficiaries because as the smaller banks go out of business, where's that business going to go? It's going to go to the larger banks. These larger banks, their balance sheets are much more stronger. They have pristine balance sheets. They've passed the Fed stress test results with flying colors. So I think they're going to be beneficiaries of the banking turmoil, but yet their stocks are down, this year. If you look at Bank of America and JP Morgan combined, they account for about 26% of the banking assets in the United States. we think that with this banking turmoil, that's actually going to increase, and the banking sector, the large banks, we think are going to do better.
So certainly some opportunities to be had, and not everyone just jump into tech. And as you said, they might have already missed the boat on that. A big thank you, Aadil Zaman, there, Wall Street Alliance Group partner. Thank you for joining us this morning.